Robert's analysis. Trump's 180-day critical minerals countdown. You need to understand what just happened in the gold and rare earth market. President Trump just activated a 180-day negotiation window that could fundamentally alter how we price strategic minerals. Yes, including gold and rare earths through diplomatic channels, first, and enforcement mechanisms, second. And if these negotiations collapse, the administration has direct authority to implement structural changes to the pricing framework you're watching right now. That's the situation. That's the trigger event. And over the next several minutes, you'll discover why this extends beyond a simple news cycle, why the initial price reaction might be the least significant movement, and why the critical inflection point could arrive on day 178, when most participants assume there's still time remaining. And here's why you need to stay until the conclusion. The initial coverage will emphasize tariffs that haven't been implemented, while the actual mechanism is the coordinated pricing framework sitting in plain view. I'll explain how that framework can compel buyers to secure supply ahead of time, why even a successful negotiation can elevate prices, and the specific indicator that reveals institutional accumulation is underway. Miss that indicator, and you'll only recognize the opportunity after the move has happened and the entry price has expanded. Before we continue deeper, quick request, I'm actively pushing back against content theft channels that steal original analysis and repost it. If you want to support genuine research, hit subscribe and comment Original Robert below. And another thing, if you want real-time updates, brief posts, my direct thoughts, plus instant voice alerts, and rapid notifications that I don't publish on YouTube, I created a Telegram channel for this. Link is in the description. Join it because when markets shift, timing outweighs commentary. Now let's discuss what this executive action actually signifies without the noise. And the implications can get serious, because the strategy isn't focused on one commodity. It's focused on a portfolio. Resources that enable energy storage, military systems, advanced manufacturing, and the coming phase of technological rivalry. Manganese, graphium, tungsten, rare earth elements, and then the two names that make the market respond like someone triggered an alarm in a packed theater. Gold and rare earths. Here's the critical detail. The first phase is not tariffs. The first phase is negotiated price baselines with strategic partners. Essentially, a synchronized minimum import valuation designed to prevent what they term destructive pricing, and to secure supply chains. It sounds diplomatic. It sounds procedural. It sounds like administrative work. But price baselines are not administrative work. Price baselines are influence. A price baseline is the purchasing side equivalent of a tariff. A tariff imposes you with additional cost. A price baseline declares this commodity cannot enter below a specified valuation. Full stop. And when you implement that across markets, you're not simply adjusting trade. You're restructuring the entire incentive architecture for extractors, processors, and purchasers. Now, observe this carefully. There are no tariffs currently. That's critical. No immediate. Let's just apply 25% across the board. Instead, they initiated the clock. 180 days. Negotiate, synchronize, coordinate. Then, if negotiations break down, minimum import valuations and Section 232 enforcement mechanisms are positioned right there, ready for deployment. And Section 232 is not a minor instrument. It's a national security mechanism. It's the kind of mechanism that can reshape entire sectors, which is why the market doesn't wait until day 180. The market starts pricing the outcome today. Now, some of you are wondering, okay, but 180 days, why that specific duration? And the answer is it's sufficient to appear measured, but compressed enough to generate urgency. It accommodates a procurement timeline. It accommodates a political timeline. It accommodates a negotiation timeline. And most critically, it accommodates a market timeline because 6 months is the optimal window for institutions to adjust positioning without broadcasting their repositioning. Here's what that means for you. In the first month, you get headlines and uncertainty. In the second and third month, you get progress narratives, selective leaks, and manufactured optimism that causes participants to relax. In months 4 and 5, you get escalation, ultimatums, hardline positions, final proposals. And that's when the actual accumulation often begins discreetly because major players don't want to be observed chasing. Then you reach month 6, where the general public realizes, wait, so what happens at the deadline? And by the time the public asks that question, informed capital has already positioned. So if you're still approaching this like a single-day news item, you're already operating behind the curve. Now, let me clarify price baselines in a way anyone can grasp. Consider it like this. If the administration declares, we will not permit imported processed gold or rare earth products to enter below a specific valuation, then the lowest cost supply vanishes immediately, not because the material disappeared, but because the framework changed. And when the lowest cost supply vanishes, everyone competes for the next available supply tier. And that's how baselines can elevate the entire pricing structure, even without additional demand. But baselines require enforcement infrastructure. You need benchmark pricing, you need verification, you need compliance reviews, you need sanctions for misrepresentation, you need anti-circumvention protocols, so entities can't reclassify products and route them through alternative categories. And that's why a baseline is not simply a number, it's an architecture. And architectures create winners. If you're aligned, compliant, and already integrated into the preferred supply network, the architecture is an advantage. If you're external, the architecture is a barrier. Now, observe how the narrative conflict will develop, because this is where people get emotionally manipulated. One faction will argue, this is protectionism, this is market interference. The other faction will argue, this is national security, this is supply resilience. Both perspectives can be accurate simultaneously, and while they debate, the only participants who consistently profit are those who position early and manage exposure. That's why I keep emphasizing the same concept. The objective isn't to be correct. The objective is to be prepared. Now, let's discuss Section 232 for a moment, because people hear it and dismiss it. Section 232 is the legal framework that categorizes trade as a security concern. And when something becomes a security concern, it receives political prioritization. That can translate to quotas. It can translate to tariffs. It can translate to restrictions on specific product classifications. It can translate to exemptions for allies and enforcement against everyone else. And it can materialize rapidly, especially if negotiations become a public failure. So the countdown is simultaneously a credibility assessment. If leadership announces, we will address this dependency, and then executes nothing, it appears weak. If leadership announces, we will address this dependency, and follows through, it appears strong. Guess which option politics typically selects when scrutiny is intense? Now, here's a fourth revelation that most participants won't anticipate. Even if negotiations succeed, you can still experience elevated prices, because a successful negotiation can still establish a minimum acceptable pricing structure. It can still incorporate commitments to prevent dumping. It can still incorporate coordinated stockpiling. It can still incorporate voluntary constraints that function as restrictions. So don't assume a diplomatic resolution equals inexpensive material. A resolution can be the mechanism that legitimizes the baseline. Now, let's examine 3 scenarios rapidly and tell me in the comments which one you consider most probable. Scenario 1, smooth resolution. Partners coordinate. Minimum pricing is quietly implemented. Supply continues flowing, but at an elevated, more stable valuation. Volatility moderates. Everyone pretends it was always predictable. This is the mature resolution outcome. Scenario 2, chaotic resolution. Discussions extend. Headlines reverse daily. Markets fluctuate violently. At the final moment, a fragmented agreement is announced, saturated with exemptions, gaps, and conditional terms. Prices oscillate because nobody trusts the specifics. This is the we prevented disaster, possibly outcome. Scenario 3, collapse. Negotiations fail. Minimum import valuations and restrictions are implemented. Retaliation threats emerge. Buyers scramble to secure supply. Extractors and processors become strategic resources, and the market reprices the entire complex rapidly. This is the disruption outcome. Now, here's the concerning element. Even if you anticipate scenario 1 is approaching, the market can still price scenario 3 for extended periods simply because the risk exists. So, risk management matters. Now, I'm going to connect this back to actionable observation again. What should you literally monitor over the next 180 days? Monitor for announcements regarding joint strategic reserves. Monitor for language around secure processing and trusted supply networks. Monitor for new funding initiatives, loan guarantees, expedited permits, or strategic alliances. Monitor for procurement modifications in defense and infrastructure contracts. Monitor for sudden adjustments in export regulations from other jurisdictions. And monitor for the quiet signal, long-term offtake contracts, because offtake contracts are where future pricing gets established. Now, let's connect this to what you observed in price action one more time, because this is how you maintain clarity. A violent sell-off following bullish developments often indicates one of 2 scenarios. Either the market was overcrowded and required a shakeout, or the market is detecting something else, like a side arrangement, an exemption, or a macro risk, before you observe it in headlines. So don't speculate, observe. If gold and rare earths stabilize following the initial shock, that's information. If they continue declining without rebounds, that's information. If they rebound, but volume disappears, that's information. If they rebound with sustained participation, that's information. This is why I prefer concise analysis. The market communicates in rapid signals too. Now, I'm going to state something that will prevent losses. Do not treat mining equities like speculation tickets. If you're going to engage mining equities, approach it like fundamental analysis. Examine reserves, jurisdiction, permits, capital structure, and the capacity to finance without diluting shareholders. Because the moment policy capital appears, the superior companies get stronger and the inferior companies get louder. And noise doesn't compensate you. Execution compensates you. Now, if you want, in a subsequent video, I can develop a framework for mining due diligence. Again, without promoting anyone, simply teaching the filter. If that's valuable, type mining framework in the comments so I understand what to produce next. And I'll ask one more engagement question because I'm genuinely interested. Do you think government establishing price baselines is evidence of strength or evidence that the free market era is concluding? Tell me your perspective because this extends beyond a trade narrative. It's a philosophical transition. All right, back to the central thread. So what did traders execute? They executed what traders always execute when an actual structural narrative impacts a highly emotional market. They overreacted. Then they contested it. You observed volatility. You observed rapid selling. You observed sharp recoveries. You observed participants calling the peak, calling the trough, then calling each other incorrect, sometimes all within the same session. Gold declined aggressively, then got accumulated, then declined again. Rare earths got pressured. Energy shifted. Yields fluctuated. Equities executed their own pattern like they typically do, treating metals as someone else's concern until they aren't. If you're questioning why the selling can be aggressive even on bullish developments, it's straightforward. Positioning. When excessive participants are already positioned one direction, bullish developments become justification for short-term profit realization, liquidation, and forced rebalancing. The narrative can be bullish while the price action is negative. But don't get mesmerized by the initial candle. The initial candle is rarely the actual message. The actual message is what develops after the market has time to process. Because this 180-day countdown isn't simply about price, it's about control. Here's what many participants overlook. If an administration establishes or enforces a price baseline, it's effectively determining the minimum revenue that foreign supply must achieve to enter the domestic framework. That can redirect flows, it can attract supply, it can disadvantage competitors, and it can accelerate production decisions that would normally require years. And then there's the component nobody prefers to acknowledge. If you can establish a minimum price, you can also justify stockpiling. You can justify subsidizing domestic refining. You can justify constructing capacity. And you can justify intervening in markets temporarily until stability returns. Temporary initiatives have a peculiar tendency of becoming permanent institutions. So if you're asking, is this bullish for gold and rare earths? The answer is, it can be bullish in a manner that doesn't appear bullish initially because in the early phase, you can experience chaos. You can experience negotiation. You can experience diplomatic headlines that sound like resolution and then become a trap. Let me demonstrate the trap. Imagine a resolution. We'll provide you access to X if you provide us access to Y. Markets appreciate that. Markets hear resolution and they purchase risk. They sell fear. They relax. But if the resolution involves exchanging strategic resources, rare earths for energy, metals for technology, supply for security, then the resolution can also constrain upside in some areas while accelerating it in others. That's why I'm emphasizing, don't simply monitor prices. Monitor the architecture being constructed behind the price, because once an architecture is established, it transforms how every decline and every rally behaves. Now, I want to pause for 2 seconds and clarify something. I'm not here to instruct you to panic purchase. I'm not here to shout moon predictions. I'm here to map the strategic landscape, and the landscape is transforming. If the administration is serious about reshoring strategic supply networks, there are 2 unavoidable outcomes. Outcome 1, elevated guaranteed pricing in certain segments of the chain because you need producers to invest. Outcome 2, capital flows toward the companies that can actually deliver actual supply. Not the most promoted tickers, not the superior marketing, but the operations that possess reserves, permits, and a pathway to production. And that's where the opportunity and the risk coexist simultaneously. Because people hear gold and they think exclusively about bullion and coins, but administrations hear gold and rare earths and they think electronics, defense, aerospace, grid infrastructure, and industrial capacity. Different purchasers, different time horizons, different tolerance levels. If you're observing from home thinking, okay, Robert, so what do I execute with this? Stay with me, because shortly we'll discuss what this could signify for physical material versus mining equities, and why some of the most significant upside may not be in the material itself, but in the infrastructure plays. But first, one quick creative mention. If you want gold success narratives from actual participants, there's a separate channel linked in the description. Subscribe there too. It's rapid inspiration for maintaining discipline when the market attempts to shake you out. All right, back to the countdown. What is the administration genuinely attempting to prevent? They're attempting to prevent being vulnerable to a limited number of foreign control points. Processed critical minerals are the constraint. It's not simply do we possess material underground, it's can we refine it, process it, convert it into the form industry actually requires, and execute it reliably. And when a probe categorizes that dependency a national security threat, you've entered into a different category. This is no longer trade policy. This is strategic policy. And strategic policy doesn't request permission from markets. It informs markets what the new framework is. Now, this is where price baselines become significant. A negotiated baseline with partners executes two functions simultaneously. It prevents ultra-low-cost supply that undermines domestic investment, and it provides producers confidence that if they expand, they won't be destroyed by sudden price dumping. That is the messaging. That's how it will be framed. But operationally, it signifies the state is influencing pricing. And when the state influences pricing, one question becomes unavoidable. Who receives favor? Because not every producer succeeds under a baseline. The winners are those who are compliant, aligned, and strategically valuable. And the losers, they can still transact, just not here or not at that price or not without constraints. So even before day 180, companies and jurisdictions begin repositioning. Some rush to comply, some delay, some threaten retaliation, some propose side arrangements, some attempt to fragment the coalition. And amid that chaos, the market is attempting to predict one thing. Will the negotiations collapse? Because if they collapse, you receive the aggressive tools, minimum import valuations, Section 232 restrictions, and potentially a broader set of actions that nobody wants to detail in a press release. That's why this is a countdown narrative. It's not one decision, it's a sequence. And sequences are where revelations exist. So let me provide you the first revelation right now. The 180 days may not be the actual deadline. The actual deadline is when major buyers determine they cannot risk waiting. And when manufacturers begin discussing, we should secure supply now. When procurement teams decide it's more economical to lock in today than to gamble on policy tomorrow, that's when stockpiling initiates. Not by administrations, but by the private sector attempting to front-run the administration. And that's when the price can move in a manner the charts cannot explain. Now, let's discuss the market action you observed because it wasn't random. Gold experienced a violent move down, then a rapid accumulation. That typically indicates two groups are competing. Group 1 is leveraged. They get forced out when volatility impacts. Group 2 possesses conviction. They enter when price reaches a level they consider undervalued. And here's what makes this moment unique. If price baselines are approaching, undervalued levels become easier to identify because policy creates an implied support. Even if the baseline isn't official yet, the market begins pricing the possibility. That's why you can observe a falling knife get caught even while the headlines are still being processed. But be cautious. A caught knife can still injure you because the session is not concluded until the session is concluded. And in markets, the second wave is often more severe than the first. So what should you monitor? Monitor how price behaves around critical levels following the first rebound. If price breaks below support, continues declining, and closes weak, then the structure is dominating and you can observe another leg down. But if price declines, recovers sharply, and maintains, then you're observing accumulation under pressure. And accumulation under pressure is how significant moves initiate. Now, I know some of you prefer pure technical analysis and some of you reject it. So I'll keep it straightforward. The chart is not the narrative. The chart is the scoreboard. Policy is the game. And the game just transformed. Now, earlier I mentioned the opportunity may be less in metals themselves and more in mining equities. Let's examine that without hype. If the administration wants secure supply, it requires production. If it requires production, it requires investment. If it requires investment, it requires profitability. If it requires profitability, it requires price. That's the chain. So a price baseline, even as a negotiated concept, is essentially declaring we might guarantee your economics, and that can revalue the companies that were previously ignored because capital was too expensive or because projects were too premature or because the market didn't care. But, and this is a significant qualifier, most mining companies are not constructed identically. Some possess actual reserves, some possess projections, some possess permits, some possess presentations, some possess management that can execute, some possess management that can only raise capital. So the opportunity is not mining equities appreciate. The opportunity is the appropriate mining equities receive an additional tailwind. And that tailwind isn't simply the metal price. It's policy support. It's access to funding. It's strategic partnerships. It's a political incentive to ensure certain projects survive. And if you identify a company that receives the metal movement plus the policy movement, you can experience a multiplier effect. But if you identify the wrong one, you experience dilution, delays, and disappointment. So if you want me to produce more content on how to evaluate mining equities, let me know below, because I can go comprehensive on what to examine without naming specific entities, without promoting, simply teaching you how to filter. Now, 2 questions for you, and answer honestly in the comments. Do you think the 180-day negotiations conclude in a diplomatic resolution? Or do you think they conclude in restrictions and disruption? And second, if gold and rare earths become strategic, do you think the average investor is early or already delayed? Share your thoughts below. I read more than you assume. Now, let's discuss the broader macro context that makes this proclamation feel like accelerant on dry material. We're in an environment where every major economy wants the identical outcome: growth without consequences. And the simplest way administrations attempt to purchase time is by weakening currency and subsidizing industry. That's not speculation, that's policy. And when multiple jurisdictions execute it simultaneously, you experience competition, not simply in trade, but in industrial capacity. That's why critical minerals are a battleground now. Not because metals are valuable, because metals are leverage. If you control the inputs, you control the outputs. If you control the outputs, you control the economic mechanism. And if you control the economic mechanism, you control negotiating power. So a proclamation on imports is actually a strategic move in a broader resource competition. Now, here's the second revelation. If price baselines get discussed for critical minerals today, what gets discussed next? Because once an administration normalizes intervening in one strategic market, it becomes simpler to intervene in another. And the market rejects uncertainty until it discovers how to profit from it. So the first movers receive compensation, and the delayed movers receive punishment. That's why I keep emphasizing pay attention to architecture. Now, I also want to address something that can confuse participants. You might observe oil declining on a session when you anticipate geopolitical concern to push it elevated. You might observe equities rally when you anticipate policy risk to push them lower. You might observe gold soften while rare earths oscillate. That doesn't signify the narrative is false. It signifies the market is a chaotic mechanism of positioning, liquidity, and cross-asset flows.